Hey, it's Tom here and welcome back to the channel. Now, for the longest time, Warren Buffett has said that his main job as CEO of Berkshire Hathaway is not necessarily to run the operations of the business, but rather to allocate capital. In other words, he has this range of operating businesses at Berkshire Hathaway that, as he says, send the cash to Omaha, and his job is basically to allocate the cash that comes in order to generate the best possible returns for Berkshire Hathaway shareholders, whether that is reinvesting it in existing businesses, whether that is repurchasing his own stock, or whether that is acquiring new businesses, whether that be in private transactions or by buying publicly listed companies in the stock market. And the role of the CEO when it comes to capital allocation, I think, is kind of understated. We often hear about really successful CEOs being visionaries in terms of running their own businesses or creating new products, but we don't often hear CEOs really talk about the power of capital allocation. And over the weekend, I got the chance to sit down and start reading this book, actually, The Outliers by William Thorndike. I'm not sure why it's taken me so long to get to this book, but it's very good. And one of the chapters in this book is actually on someone who has almost as good a capital allocation and stock return track record as Warren Buffett. In fact, it's actually very slightly better. Warren Buffett has compounded at about 20% a year at Berkshire Hathaway, and the man who is the topic of this video, Henry Singleton, has compounded at about 20.4% per year throughout his career. Buffett has been doing it for decades and decades and decades, and Henry Singleton did it for about 30 years or so with his company Teledyne. But the thing that's really unique about Henry Singleton and the way that he approached capital allocation and generating high returns for shareholders is he actually made extremely aggressive use of his stock. We know that people like Warren Buffett are big proponents of things like share buybacks, and Henry Singleton, the man who is the topic of this video, was really no exception to that. He bought shares back like an absolute machine. He actually retired 90% of his company's shares outstanding in the later part of his career. But he was actually also very aggressive in issuing stock when buying new companies and making acquisitions. So in this video, I want to cover the topic of Henry Singleton and Teledyne as written about in The Outsiders by William Thorndike. And I want to explain how from 1963 through to 1990, Henry Singleton turned every $1 invested in his company Teledyne into over $180. But before we get into that, we do have a sponsor for today's video, and this video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing as a Kiwi based here in New Zealand. And in 2022, Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your first home, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch to help make my plans a reality. If you want to get started investing with Hatch, check out the first link in the description, where you can get a free $20 New Zealand dollar top up when you make your first deposit of $100 New Zealand dollars or more before the 30th of June 2022. Now, very briefly, before we get into what Henry Singleton actually did at Teledyne to have such phenomenal returns for his shareholders, I want to touch very briefly on Henry Singleton's background because it is not very typical of a public company CEO. Henry Singleton actually had a background in both mathematics and electrical engineering, and when he founded his company Teledyne and took it public, it was basically a collection of small electronic components companies. And over time, he went on to grow the business massively in terms of acquiring new businesses through issuing stock in a lot of cases, as we'll get into in this video. And being the mathematician that he was, he took a very quantitative approach to running his business and growing the wealth of shareholders, really regardless of how unconventional people perceived that approach to be. Now on the screen here, I will put up a table from the book, which really explains about the first decade of Henry Singleton's management at Teledyne. And basically what this table shows is the successful way in which Henry Singleton grew the business through acquisition. And in particular, he not only acquired good businesses, but the way he funded those purchases was really interesting to me. Now, in the table here, you will just see monster growth across various aspects of the business. He grew sales of the company 244 times. He grew net income 555 times, taking it from only $100,000 in 1961 to $32.3 million in 1971. He grew earnings per share almost 65 times. He grew the shares outstanding in the process about 13 times, and we will definitely get to that in a sec, because typically, and I'm guilty of this for sure, I've been fairly critical of companies that issue shares, but Henry Singleton did that in a particularly intelligent way. And he also did take on some debt at Teledyne as well. So he grew the debt load at the business by about 29 times, nowhere near as dramatic a growth as the revenue and the net income at Teledyne, but that is worth noting as well. Now, a couple of things really jump out at me here other than just the massive growth in general, and the main one is to do with sort of the ratio between shares issued and the actual net income and sales growth of the business. Now, typically when a company makes an acquisition and they pay a reasonable price for a reasonable quality business, they're not getting a spectacular deal or anything like that, and maybe they do issue shares to make that acquisition. All things being equal, we would often see that a company might say double their share count if they were a very aggressive issuer of shares, and maybe that would allow them to buy a business that would also double their revenue and their earnings. And yes, that potentially creates value for shareholders. Maybe it offers some sort of diversification in terms of their lines of business, or maybe it evens out the cyclicality in the business, but really we've just grown the pie, and we've also grown the pieces of the pie in proportion to that. So each individual shareholder on a per share basis has really not moved forward significantly, and that really wasn't the case at Teledyne. Sure, Henry Singleton issued a huge amount of shares. He grew the share count, like I say, by about 13.7 times, but he grew the earnings per share multiples of that 13.7 times. He grew the earnings per share of the business by almost 65 times. And the way that Henry Singleton basically did that is he was taking advantage of an arbitrage in the multiple that his public stock was trading at, and the multiple for which he could buy private businesses. If he could issue shares at 20 times earnings in the public markets with his stock, Teledyne, if he could issue more shares at that at a valuation of 20 times earnings, and then he could take those proceeds and go and buy a business in the private market at 10 times earnings, he saw that as a way to create a lot of value for shareholders. Now, moving to the next period in time in Henry Singleton's career at Teledyne, this time looking from 1971 to 1984, there was really a stark contrast in the way that Henry Singleton allocated capital at Teledyne. And the reason really that he did that was because there was a huge change in the multiple that his stock tended to trade for. There was no longer this huge arbitrage opportunity where he could issue shares at a high multiple and then buy businesses at a low multiple. Instead, it actually reversed, and his stock traded at a lower multiple. It was quite a complicated business. They made a huge number of acquisitions, and it was very hard to analyze. It traded at a more modest multiple over time, and there really wasn't the opportunity to issue shares at a high multiple and buy private businesses at a low multiple. That had kind of gone away. So instead, what Henry Singleton did is basically reverse the playbook, and rather than going out and issuing new shares and acquiring new businesses, he really substantially dialed back his acquisition activity, and instead he started repurchasing the stock because he thought that it was undervalued. And there's actually a quote in this chapter of The Outsiders from none other than Charlie Munger. And Munger was quoted as saying, "No one has ever bought in shares as aggressively," in reference to Henry Singleton and Teledyne. And as you'll see in the table here, that aggressive share buyback quote from Charlie Munger potentially was an understatement. Henry Singleton actually bought back 90% of the shares outstanding between 1971 and 1984. At the same time, his sales a little more than doubled on an absolute basis, obviously much more than that on a per share basis because he retired so many of the shares. But his sales doubled, his net income actually went up about 7 times, and there was, again, a little bit of debt growth through that period. But super aggressive reduction in shares outstanding, going from 6.6 million in 1971 to only 900,000 in 1984. And there's a sentence in this chapter that really kind of tells the story about Henry Singleton's approach to issuing shares versus buying them back. And that's basically that throughout his career, on average, when Henry Singleton issued shares, they were trading for a PE multiple of 25 times, which he thought was kind of expensive, given interest rates and so on, and how he could acquire private businesses at lower multiples. But on average, he issued shares at 25 times, and on average, he repurchased shares at about a PE of 8. And the final chart here will show how that rolled through into stock performance throughout Henry Singleton's career. This doesn't capture the first very early years of Henry Singleton managing Teledyne, but it captures the entire period for which there is reliable, basically, stock price data. It also includes a few of the spin-offs that were done in later years at Teledyne as well. It got a little complicated, but thank you to William Thorndike, who wrote this book, for putting this chart together. And here you'll see that Teledyne compounded at 20.4% per year. That compares to basically other conglomerates that were kind of comparable to Teledyne, did about 11.6%, and the S&P 500 with dividends included did about 8% per year. So that is the story of Henry Singleton and Teledyne, and how he basically used his stock to acquire businesses and take advantage of that sort of price to earnings multiple arbitrage when he had the opportunity. And he did it super aggressively. And then it's quite cool to see them basically flick the switch at Teledyne and go the other direction, and then repurchase shares like madmen for the second half of Henry Singleton's career. So it's one of the craziest stories I've ever seen on capital allocation, and it just goes to show that, when Buffett says he sees his main job as allocating capital effectively, it demonstrates just how important that is and how big an impact it can have on shareholders at the end of the day. So that's it from me for this one. I do hope you enjoyed the video. If you did, please hit like and also hit subscribe. If you're interested in the Hatch offer, there will be a link down in the description to get your free $20 top up. But that's it from me for this video, and I'll see you in the next one. Cheers.